that. Quickly, let's look at the accounting processes. Accounting processes, and when we talk about accounting processes, what are the processes that are involved in it? Let's look at the accounting processes. You know, the processes, what we're talking about is you being able to do proper renditions when it comes to accounting, as it were. What we are just doing is to build up the basics. More or less, this is an overview of what it's all about. Accounting, as it were, is for you being able to prepare adequate financial. So the processes begins with from the definition of items. Definition of items on the financial statement, and to definition, to recognition, to measurement, to presentation and disclosure. Don't mind this, my marker, just please manage with it. Presentation and disclosure. So, definition talks about giving the items the definition that is needed. And as an accountant, you must know the definition of every item that is on the financial statement. They are all classified under the element of financial statement. When we get to conceptual framework, we build more on that element of financial statement. So you have the assets, you have liability, you have equity, you have expense, and then you have income. So all of these, they have their definition. So each of the items of financial statement must also align with every of these elements of financial. When we get to conceptual framework, like I said, we'll look at that. Then the recognition. The recognition is all about how it should be classified on the financial statement. It is important as an accountant that you must know how each of these items, or all the items, maybe for instance your expenses, where they fall into, your liability, you should know where they fall into, your equity, all those items that made up such, all those components that make up such of this classification, you should be able to know that. That's under the recognition. Then we have the measurement. Measurement talks about the calculation, how you are to calculate all of each of these items and then put them into figures. Accounting is all about figures. Although we have what we call notes of the account, and we talk about how you comply with the policies and the processes. And then you have the presentation and the disclosure. This is also very important as an accountant. So these are the processes. We'll build more on that when we'll get to our subsequent classes. So very quickly, let's look at the accounting basis and then the concept. The accounting basis and the concept. So when we talk about accounting basis and the concept, we are looking at the guidelines, what you are to follow as an accountant when you are preparing your financial statement of your financial report, as it were. And so we have what we call three basic accounting bases. So we have what we call the accrual basis. This accrual basis talks about recognition of events or circumstances within a period of time as at when that event occurred. Take for instance, I went to recognize revenue. Accrual is talking about the historical background, historical cost, as it were. Now, for you to recognize revenue, you need to look at when the transaction actually occurred. Not necessarily when you receive cash. The term accrual means it has happened before you receive the cash. So what we are saying is this: you recognize an item on the financial statement, you can use the accrual basis. Recognize that item when the transaction for that item occurred. That's number one. Number two, we have the cash basis. The cash basis is talking about the fact that you recognize an item when cash is received. When cash is received. The first one is talking about recognizing the item when the transaction occurred. when transaction occur. The second one is talking about when cash is received, and the third one is the breakup basis. The breakup basis. This one is looking at the fact that the company will be in existence in longevity. That's for into perpetuity, as it were. While the breakup is looking at the fact that the company, maybe when they break up, how do you recognize items in the financial statement?